Hello, my name is Julien Nillon. I'm a financial analyst and the founder of LPE Research, an independent equity research firm exclusively dedicated to asset managers and specialized on French small caps. Last week, we have been working on the company SergeFerrari, and today I'm going to present our first analysis on this stock. Before I begin, I would like to remind you that this video is not an investment advice, but only an opinion. We do not do any business with SergeFerrari and do not hold any long or short position on its shares. Having said that, let's get started. SergeFerrari is a company specialized in the manufacture of flexible composite membranes and fabric used in many applications, such as lightweight roofing, modular structures, furniture, yachting, sun protection. SergeFerrari is listed since 2014, and at the time of the IPO, the company set an ambitious 4-year goal of growing sales by 50% organically and achieving an EBITDA margin of 15%. Unfortunately, the group fell far short from its objectives. Revenue growth was much more modest than expected, and the group saw its margin shrink. Far from its original objectives, SergeFerrari recorded a net loss in 2018. Its result rebounded in 2019, but fell again in 2020 due to the COVID crisis. Today, its share is still trading below its IPO price. The first reason for this failure is that the group didn't succeed to expanding outside Europe as planned. Indeed, the group objectives were to increase turnover outside Europe to 40% of sales compared to 24% in 2013. In 2019, before the COVID crisis, SergeFerrari was still making 3/4 of its sales in Europe. The problem is that to achieve this growth, the group invested heavily and recruited in particular many sales representatives, thereby increasing its cost. Before 2015 and 2017, personnel costs as a percentage of sales increased by more than 20 basis points and drove profit down accordingly. The second reason SergeFerrari failed to meet its objectives was the company had to face negative price-cost squeeze. Indeed, the group gross margin is very directly dependent on the correlation between the cost of its oil-based plastic raw materials and its selling price. The group generally managed to pass with lag the increase in raw materials, but can see its gross margin affected by this movement more or less temporarily. In the first part of the 2010s years, the group enjoyed a margin expansion, but in 2017 and 2018, SergeFerrari faced a negative price-cost squeeze. Let's add that the group was unlucky and had to face a fire in its main production unit in late 2019 and the COVID crisis in 2020. You understand its problems. The good news is that these problems now seem to be behind us. SergeFerrari is benefiting from the strong rebound in the economy and has taken advantage of this post-exceptional performance in the first half of 2021. Compared to 2019, the group has more than doubled its operating profit. This turnaround is due to the strong growth in the solar protection, marine and furniture markets, which are perfectly in line with the post-COVID consumer desire for the outdoors. But it's also explained by the successful integration of two important acquisitions made in 2020. Versailles in Germany and FIT in Taiwan, which together contribute more than 20% to sales and operating income. That said, the most important thing that we have is that we believe this turnaround is not over and will continue into 2022 and 2023. First, it is necessary to understand that in H1, SergeFerrari suffered from a certain margin squeeze linked to the surge in raw material costs, and has not recovered the pre-crisis volumes in tensile architecture, its first division. Since then, the company has significantly increased its prices to rebuild its gross margin. This increase should have a progressively positive impact, but especially in 2022. Moreover, if oil and plastic prices were to stabilize or fall to a global economic slowdown, margins could reach a new high. Second, in a context of gradual lifting of sanitary constraints, we can anticipate a strong pickup in tensile architecture, which is closely linked to sport and trade fair events. Finally, the group results should benefit over the next 2 years from the very significant synergies linked to the integration of SITAG and FIT. From a commercial point of view, these two operations should enable the group to accelerate its growth outside Europe. The Taiwanese company FIT offers new prospects in Asia, and SITAG gives a new dimension to the group product offering. On the industrial levels, SergeFerrari has undertaken a major restructuring and transfers between Switzerland and Germany, which should lead also to significant cost reduction. We expect the major part of these synergies to be achieved in 2023. As a consequence, and in total, we estimate that EPS will grow by 50% between 2021 and 2022-23. Moving to valuation, it should first be noted that SergeFerrari share price has risen by more than 30% recently. It is also important to keep in mind that its stock reputation is not good, because the company has disappointing in the past, but also because it's always vague when communicating its prospects. However, we believe that investors are significantly underestimating its earning growth prospects we detailed before. The consensus forecast for 2022 is an EPS of €1. We expect an EPS of €1.5. SergeFerrari is valued at barely 5 times EBITDA. We believe that the group should easily trade on an EV/EBITDA multiple of 6.5 times for 2031. On this multiple, the stock should be around €15. That is for today. I hope you have enjoyed this video. If you would like to know more about our opinion, you can contact us and order our first analysis pack that's included our presentation, our forecast and valuation model, our stock reputation measurement, and allow you to discuss with me. In the meantime, do not hesitate to subscribe to our YouTube channel or to visit our website at lperesearch.com. Thank you very much and see you soon!